in terms of getting the service or provide you affordability so you can access the service. I see the smirk. Okay, what's
No,
the
this is
question?
pretty new to me. So far, I kind of understand everything you're saying.
Okay.
So basically, he's a business coach.
Yeah.
I want his service. He's going to charge me $5,000 to do it.
Exactly.
I come to you. You're going to pretty much pay for the service.
If he can't, right, if you don't have, if say for example, whatever financing you have in place or whatever his payments system is set up and you don't fit into that due to whatever reason it may be, okay, and you want to have the service, consumer finance allows you to still have the service through their financing. They'll advance him, okay? It's a great relationship for the business owner because he's gonna get paid, right? And then in the event, let's say for example, you decide to default on it or something, the great thing about the business client now, all he has to do is have another person to replace, have another client that replace that particular contract or have someone that supplement that particular financing lease.
Okay, so how does that work into, let's say, large ticket businesses? It could be an auto repair shop. It could be $5 grand, 10 grand to get a service. Maybe even medical. Those services could be a lot.
Right.
You need the service. Does that just apply to that, or is there like a specific industry or?
Well, again, I mean, those type of industries, they probably won't set up for this. More than like, this is more for, like I said, industries that have high margins. And really, what you say high margins is people with very, very less expenses, right? He just maybe have an office and a phone. And the relationship, most of the expenses is time and he's sitting down with you. Those industries like, like you said, the auto repair shop, I mean, they're gonna put a lien on your car. Like, if you don't, whatever that is that they're gonna, if they're fixing your car, they're gonna hold your car.
I mean, but to even get the car fixed, you have to have the money to pay for it.
Right, what I'm saying, what you're saying, I guess what I'm asking you is that, did you turn your car in?
No.
Okay.
I'm considering getting service.
Okay.
From the repair
Yeah,
shop.
okay.
Would they finance?
No, they're not gonna, that's too much a risk for them.
Okay.
I mean, again, I don't want to say no, but generally I'll always see companies or businesses that are more high margin, which is like personal consultants. That's the industry that I generally see with those particular businesses there. Again, I'm not saying that industry wouldn't be there, but generally it's always someone who's like a consultant. Those type of industries like more auto repair, they will get like a line or a term loan, and they kind of expect that type of cost to be a part of.
Now, is this set up with the consultant where they offer it to their clients or prospective clients? Are they a part of some board or something?
Exactly, right. So let's say if you went to him as a business coach, and he kind of goes over his fee schedule, and you say, I can't really afford it, and he'll say, well, it may be another option for him. He may utilize for the service, and if that doesn't work, you say, well, I do have another option for you.
Okay.
We can look at this, okay? And again, a lot of times with the consumer financing piece, I don't have a FICO score here, but the FICO scores are a little lower. They're a lot more flexible, and that's why somebody would go with this option because they really can't get approved for traditional. They can't go to a bank and get $2,000 for the service. So they say, well, I'll go to a consumer finance company, or basically, it's a relationship with the bank and the business owner that they'll work something out so you can still utilize the service. Okay. And this is good too. Oh yeah, go ahead, Chris.
So you were saying we need his service. It costs $5,000. You're funded, and we pay you.
Mm-hmm.
If I default, does he have to pay it back?
No, he doesn't have to pay it back. He has to just either have another client that basically, essentially, signs up.
So the agreement's really between you and him.
Exactly.
Not between me
Exactly.
and you.
Exactly. Yeah.
Oh,
All
okay.
right, that's what.
Yeah, let's clear that up.
So I work
Yeah,
for
that's
you.
what I was doing.
Huh?
I work for you.
No, not exactly. Yeah. Well, again, I mean,
just kidding.
yeah, exactly. You're gonna work for the bank regardless. But the reality of it is that it's another option, right? It's another option for someone that wants the service, they just can't afford it, and a lot of times these people they're making payments on it. It's like it's installment payments. It's like a monthly payment, $100, whatever it may be. But it's just an option for them to be able to utilize the service, if they don't have the outright funding for it. Any questions? Questions on this? Okay.
Interesting.
Okay. All right. Okay. Equipment financing. Okay. Equipment finance is a great option. This is good for any type of equipment. A lot of times you'll see this, with any type of machinery, technology. A lot of times you'll see also too with like what they call yellow iron companies. Yellow iron is like construction companies. You see like bulldozers, cranes. They'll look at financing it up to 100% financing. Because the great thing about this for the bank is this is collateral, right? This is like real estate. So if any event they default, they could always take it back. And you know, a lot of those organizations that, I mean, that equipment can be very expensive if you start pricing out trucking and things like that. So 3 months bank statements, you know, it's good for startups too. You know, this is a lot of times if you went to a traditional setting, they're not gonna find, if you're a startup in a traditional setting, they're not gonna do business with you. That's the reality of it. That's the reality of it. So the lenders, they do offer this. Yep, it's pretty much, the rates on these are, you know, I would say anywhere between 10 and 15% on the financing piece. The terms are generally within like 5 to 10 years. You don't really see any equipment over 10 years. Generally pretty much 5 to 7.
All right, so from a minimum, is there a minimum amount you can finance? Is there a maximum amount? And give you a hypothetical, let's say a restaurant, they're gonna open a large one, they need a bunch of POSs, some of them could run $40,000.
Right.
For that whole system. Would that fit into that?
That would certainly fit into this. I would say minimum from the lenders that I work with, anywhere from, let's say, 10,000 to about at least $1 million. You know, of course, it can go higher than that, but you know, just generally, that's I would say the range. But yeah, this would be good for, again, any type of machinery, equipment, things that, you know, it will be a big hit to your, you know, to your income statement. You know, I would certainly recommend this.
Like a doctor's office if they are.
Exactly. This would be perfect for, like, you know, X-rays, those machines. Man, this would be perfect to finance that, you know. Or, you know, I would really recommend if a doctor, I mean, this is an option. I'm just telling you some options, but we also have a program too. It's called leasing. You know, it may be more cost effective to lease it versus financing it over a period of time. Because again, from a write-off standpoint, you know, I know Chris can kind of talk about that, but you know, just depends on the cost. You got to look at the margins. Like, is it cheaper to lease this, or is it cheaper to, you know, essentially, you know, try to buy it or finance it right out? You got to really kind of see what's beneficial for you. But again, if it's, because a lot of times with the leasing, it's just like anything else. Like now people are leasing phones, right? A lot of no one buys phones, right? It's leasing phones because newer technology. You're paying this off. You had it for 5 years, but now newer technology came out. You spent $50,000 already in it, and now it's outdated. Same thing with you know, card processing. Yeah.
I got you. So let's say you decide to lease equipment. It could be any equipment.
Yeah.
Who owns the equipment? Are they going to go ahead and buy the equipment and lease it to you? Like, how does that work?
Well, a lot of times these companies, they own equipment, and so just like with the merchant services, you will be in a lease contract, and then you can buy it back after, you know, let's say 5 years, buy it back for $1. So it's basically a lease buyback option. So you'll lease it for, you know, 5 years, 7 years, and then you can buy it back. But in a lot of cases too, it just makes more sense to, you know, it may make more sense just to lease because depending on the industry, and you may just want the latest technology.
Yeah, so what I'm trying to get at, I get the leasing aspect and how that aspect works, but how does it apply to, let's say, computers versus, you know, again, an X-ray machine versus, you know, restaurant equipment, a stove. Okay. Do I just say I want to lease a stove and I just come to you, you automatically know where to get the stove from, lease it?
No. So what happens is, what you do is you find the equipment you're looking to do, right? And then we look at your financials, and then we'll try to find a structure under that. So no, you'll find it. Okay, you'll find it, and we'll provide just the finance.
Okay, I got you.
Yeah, that's all it is. I mean, we're the bank. You find it. Yeah, so that's how that works. Any questions? Any questions around this? Okay. All right. Yeah, this is what I talked about. This is kind of comparable to the account receivable we were talking about. This is the same thing, pretty much business to business. The difference from this versus the account receivable financing is that this is a line. And essentially this would be up to like almost, it doesn't even have to have an amount. Because it just depends on your receivable. If you're awarded a government contract and you're expecting, you know, over $20 million in revenue, you know, receivables, we'll see this and say, hey, wow, you have a contract with, you know, XY company, this company here. You have a lot of assets that's coming in. Right. Based on your relationship, we'll just give you a line. So this is great. And basically the line starts at 250. Or the receivables have to be 250 and higher. So this is great too because again, lines are always good versus just, you know, term loans or loans because, you know, when a line is revolving, you know, once you get that term loan, you really got to start paying on it right away. Like if you're not doing business, you need to start doing business, right? You can just have a line, you know, like Ebony got a line, right? You know, and just kind of just wait, and it's there for emergency purposes to allow you to really generate more revenue for your business and invest back into the business. So, but yeah, I mean, all these options are some good options. I mean, I would say the main takeaway, any questions about this right here in general? I would say, you know, before, I know some of you were kind of walking in, we talked about the commercial card. The commercial card is great for business owners that are startups or even their existing